Good morning, everyone. Welcome to Office Adda 24/7. My name is Niharika Valia, and I am here with you for the class of JAIIB AFB. So, let's proceed further. Okay. Our batches for the JIB November-December batch has just begun. It has just started on 16th of August. Yeah, that means yesterday. So at this point of time, if you would like to purchase this particular batch, the timing for the AFP for this batch is morning 8 a.m. to 9 a.m. I'm sorry. And at the same time, we have also started with the entire batch. Then that means this is not only for AFP, this also covers PPB as well as the LRB. And the timings for the entire working would be 6 a.m. to 10 p.m. And at the same time, if you would like to purchase it, you will be getting live classes, the recorded ones of the same. Then the next thing that you will be getting is ebooks as well as the test series. So this is the entire um, set of things that would be available to you if you look forward to the English medium batch that has just started yesterday. And if you would like to avail discount, at present the discount is going off up to 81% by using the code Y541. So let's move forward. Okay, this is the set of the questions that I'll be dealing with today. The first question says a forfeited share can not be reissued at discount, reissued at a maximum discount of 10%, be reissued at a maximum discount equal to the amount forfeited, or none of the above. Ideally, there is a saying, there's a particular, not only saying, this is basically a rule that you will find that shares cannot be issued at discount. It's a rule. You'll find it in terms of debentures, it is allowed, but in terms of shares, ideally it's not allowed now. So in this case, what happens here is a share forfeiture, where there's a share that has been forfeited, that can be reissued, but it cannot be reissued at an amount more than what was forfeited. That means if that particular share was of rupees 10 and the previous shareholder had given maybe has given 6 rupees out of 10 rupees, out of which this particular amount was forfeited and this particular person failed to pay the remaining amount, so we kept his entire share. Then this share was reissued to a new shareholder. He is supposed to pay only the next 4 rupees. And if it is less than that, that is not allowed. Whatever amount has already been received, this is the maximum discount we can offer to anybody. This is the maximum discount. This is not only even a discount, this is something which we have already received, so we won't be asking it from the new shareholder. So this is how we define a forfeited share. So the reissued shares can be issued at a maximum discount equal to the amount forfeited. Second question. These shares, which in addition to the fixed preference dividend, carry a right to participate in the surplus profits, if any, after the dividend at a stipulated rate has been paid to the equity holders, are called. These are participating preference shares, convertible preference shares, redeemable preference shares, or cumulative preference shares. Preference shares can be divided on the basis of this into 8 different classes. That is something that we'll find. Number 1 is called participating preference share. Number 2 is convertible. Number 3 is redeemable. Number 4 is cumulative preference shares. So when we define preference shares, the preference shares can be participating, convertible, redeemable, or cumulative. Participating are those who are basically covered in the fact that first of all they are preference shareholders, so they'll get the preference share dividend. First of all, they get their preference share dividend. Then the payment is made to the equity. But at the same time, after this even, we have got a good chunk of profit left. So now this profit will again be distributed among the equity. But this extra surplus, this surplus can be claimed by a specific set of preference shareholders. All the preference shareholders cannot get a hold of this new surplus because again it's the leftover, and leftover is idly in the hands of equity shareholders. So this kind of preference shares are called the participating preference shares. Convertible are basically those which can be converted into any other form of securities or even preference shares. Or when we talk about redeemable, the ones which have to be repaid during a particular lifetime of that particular asset of that particular company. That means after 20 years in our country, it is compulsory to repay the preference shares within the period of 20 years. And then we have the cumulative preference shares. Cumulative means if you are not able to pay them the arrears in this year, we'll pay that particular area in the next year. Arrears of dividend. The dividend is to be paid. So even if there's a failure this year, we'll pay it the next year. Next question. The matching concept matches which of the following? This is one of the basic concepts which we that deal in terms of the concepts of accounting. It says assets with liabilities, capital with income, revenue with expenses, or expenses with capital. The matching concept. This concept clearly states that whatever expense that you are incurring is incurred because of one sole reason. Do you know what's the reason? We make all the expenses, we purchase all the assets just because we want income. So, whatever expense we incur for this year to earn this year's income will be noted with this year's income. Both of these things are for the same year. It would be classified as revenue with expenses. The third point. Now let's move on. Question number 4. In the company's balance sheet, provision for employee benefits to be settled within 12 months is to be shown as. Sometimes, idly, when we find this particular thing, employee benefit expenses or the specific provisions which are made for a longer period, they go in the long-term provisions. Now, the point is, these are provision for employee benefits which are to be settled within a period of 12 months. How do you put it there? Is it a non-current liability? Is it a current liability, or current assets or non-current assets? See, we are supposed to pay someone. That means it is going to be a liability first. So if I think of the liabilities, now the answer can be limited between non-current and current liability. When we talk about this area, the answer would be current, just because it is settled within a period of 12 months. If it is not settled within a period of 12 months, then it would go as non-current. If it is settled within 12 months, it is current. Now there's a company. Question number 5. A company lost its vital machinery in an accident on 2nd of March 2021. Which will have an adverse impact on its production capacity. As a result, it is likely to lose business to its competitors. If any vital machinery is lost at that point of time, the organization is somehow it turns handicapped, because if you lose your major important machinery, that becomes difficult now. At that point of time, you have loss of profit as well. You could have earned, but now you cannot because you don't have the machinery to earn. The company needs to disclose this fact in this annual report for the year ended 31st March 2021. Because of which principle? Excuse me. Is it materiality concept? Is it material measurement, money measurement concept, and full disclosure concept? The third one is money measurement concept, and the last one is full disclosure concept. Oh, just give me a moment. I think this would be helpful. We can go through the question now. The point is, it is very important to disclose that we might face an issue which can affect our going concern, isn't it? Our going concern concept can be threatened if this kind of situation still persists or continues. So in this case, the correct answer will be the materiality concept. Next question. The opening inventory is of rupees 11 lakh, closing inventory 1 lakh 50, purchases of 6 lakh, carriage of 25,000 and wages of 2 lakh. What is the value for inventory turnover ratio? To calculate the inventory turnover ratio, you need to calculate the cost of goods sold first. For cost of goods sold, because the actual formula for inventory turnover ratio is COGS upon average stock. So the average stock would be opening plus closing divided by 2. How do we get it? We have got closing as 1 lakh 50, opening as 11 lakh, right? So calculate it. I think I'll be changing this particular point. Okay, now let's go ahead and calculate it. 11 lakh plus 1 lakh 50 divided by 2. So let's calculate it. 11 lakh plus 1 lakh 50. That gives us 12 lakh 50 divided by 2. So the average is coming out at, average stock is coming out at rupees 625,000. Now the problem is we need to know the COGS as well. So once we want to know the COGS would be opening stock. It would be opening stock plus purchases minus closing stock, where the opening stock was 11 lakh plus direct expenses as well. We have seen the direct expenses like carriage as well as wages. Plus the purchases were of 6 lakhs. They paid carriage, treated as direct expense. They also have wages paid to the people and the closing inventory of 1 lakh 50. This is how we calculate the cost of goods sold. This portion. This is the opening stock, this is the purchases, and then first direct expense, second direct expense, and this portion is your closing stock, which would be ultimately deducted. Right? So this is how we calculate it. Just add it up. 11 lakh plus 6 lakh plus 25,000 plus 2 lakh minus 1 lakh 50,000. It comes out to be 17 lakh 75,000. Now all you have to do is divide it. 17 lakh 75,000 divided by 625, that gives us 2.84 times. So the value basically is coming as a varied amount. That means the answer is none of the above. Right? This is not the answer. The answer is none of the above. Let's move on. Another question. The net profit of the company is rupees 2 lakh. The preference dividend is of 25,000. The taxes paid is 15,000. The number of equity shares is 1 lakh. What is the earning per share? How do we define earning per share? When we say the term earning per share, it means the earnings made on each and every share. How do we calculate this? Each and every equity share. We're not worried about the preference. Remember, this particular portion, EPS, is the earnings of each and every equity share. The profit was of rupees 2 lakhs. Then we had paid a specific tax as well. So let's pay the taxes first. And whatever is left would be paid to the preference shareholders first. That means the profit. First of all, from the profit, we pay off the taxes. Then the preference shareholders, it would be paid 25,000. Yeah, this is 25,000. So whatever is left is given to the equity shareholders. That comes out to be 1,60,000. Now 1,60,000 can be given, but this 1,60,000 has to be divided by the number of equity shareholders, because this is earning per share. What do you earn per share? So there are overall how many shares? 1 lakh shares. So that means 1.6 rupees per share. The correct answer is 1.6 rupees per share. Right? Question number 8. Which account will be debited in the journal entry for the transfer of accumulated depreciation on asset disposed of? If an asset is disposed of, right, it is being sold now. So if we have accumulated depreciation, which account will be debited in the journal entry? When we talk about this, the asset is gone, that means it cannot be debited. One of the basic things. This is debited already. If we are disposing of an asset, that means we are selling off that asset. If the question doesn't state clearly that in this case we are preparing asset disposal account, we will not debit it in there. And at the same time, when we talk about the sale of that particular asset, if the asset is gone, if we have any accumulated depreciation for that asset, it has to be written off. That means provision for depreciation. Currently, this has to be eliminated because the asset is gone. All the accumulated depreciation has to be eliminated, or it has to be written off, because there is no longer the asset. If the asset is no longer there, there is no meaning to keep the provision for the same. That is provision for depreciation account. Dash represents a potential obligation that could be created depending on the outcome of an asset. This is a potential obligation. We might have to pay someone in the upcoming future because of a specific event, and that particular event, whether it would happen or not, that is also uncertain. So is it an internal liability, or the current liability, or contingent liability, or non-current liability? Since there's an element of uncertainty, wherever you'll find uncertainty, these kind of points don't even get a place in their organizations um, balance sheet. Even these kind of things do not even get a recognition. They're just written in the footnote because of the fact that these problems has to be just disclosed. These haven't been certain that we have to pay it. ऐसा कुछ है नहीं. There's nothing that we have specified that this particular amount has to be paid in any case. There's nothing like that. So in this case, the point that would come out to be would be the contingent liability. Right? These are the liabilities which can occur in the upcoming future. They haven't occurred yet. They can occur in the upcoming future. Last question. Which of the following transactions will improve a current ratio? Current ratio is one of the first ratios in terms of the liquidity. It is CA upon CL. So, let's see. What are the points? First is credit purchases of goods. If we have purchased goods on credit, we have got book goods at this point of time. That is added in the current assets, but we have also got a creditor to pay off. I don't think there would be an improvement because the same amount was added there. Then the next point is payment to trade payables. If we make the payment, that means current assets we lose cash, and current liabilities we also lose creditors. The second point. Next is purchase of goods for cash. This is current assets minus the cash and plus the stock divided by still current liabilities. And the first one is cash collected from trade receivables. If I talk about the first one, it states we have received cash, but we have lost our trade receivables, and the current liabilities remains the same. Now, how will you calculate it? Which one would exactly improve it? Okay. When we talk about this, I think this one will make the difference. Why? Because it is deducted from both the areas. Let's take it that way. The current ratio was 2:1, and multiplying both the sides by 10,000. I'm keeping it as an assumption that helps us to calculate the answer. Okay. I'm taking it as 20,000 and 10,000. If 20,000 was the earlier current assets and we deduct, say we paid 5,000. So in this case, what has happened is 5,000 from the cash is gone and 5,000 from the creditor is gone. We have got 15,000 divided by 5,000. Oh, now is it better? Now that we don't have to pay 20,000 minus 5,000 divided by 10,000 minus 5,000, because we have lost cash, we've also lost the creditor. So in this case, the amount will come out to be 3:1. By paying the amount to one of our trade payables, we are done with this. So there's an improvement clearly. It was, if we take it earlier at 2:1, now it has become 3:1. From the point of view of payment to the trade payables, we receive certain money there. We are in terms of improving our current ratio. Right? So this is the end of the particular class. If you're looking forward towards JAIIB or CAIIB classes, it has just begun. A batch has just started yesterday. So if you haven't reviewed the batch yet, so let me show you how can you go when you're opening up our website. Okay. On our website, you just have to go onto this area. This is the official website for Adda 24/7, that is www.adda247.com. And when you go down, this is JAIIB and CAIIB. This is stated, and this is JAIIB November December English medium batch, which has just started. In the English medium batch, we have all the three subjects together, and this is only for PPB, AFB, and then we have LRB. So if I click on the area of AFB there, you will find all the details. The study plan is available here. What will you get is all stated. There are more than 15 plus ebooks are there, plus study material is also there. That means at the same time, you'll also get more than 45 hours of two-way interactive classes, and at the same time, the recordings are available to you. You can review it as much times as you want. That is something that is available for you. And then any further details that you would like to go through, kindly go through here only. It is all stated regarding the faculty that will be teaching. Priyanshu ma'am and I'll be taking up the area of this particular examination of AFP. And all you need to do is just click on this area and then enter the code Y541. So if you apply this code Y541, you will get a discount there, and the discount at this point of time is 80%. So this will give you a particular amount that you will have to pay only 1299.80. So if you haven't reviewed our course yet, then kindly go ahead and review it. This is a particular time where you will get the opportunity to grab this particular course at a lower price, and at the same time the faculty would be teaching live at this point of time. Even if you buy later on, then you might be getting a few of the recording classes. Here you have all the point there, you can have live classes, so why not, right? So let's meet in the next class.